Hey out there traders, more importantly than finding a good stock is trade management. Do you have a plan? Let me show you the basic Wall Street IO trade management. This is taking a doji setup. What you see here is you see a doji on support. This was found by our proprietary scanner. Now I'm going to move my face so you can see the whole chart. When you see a setup, number one is where is your entry? I'm going to use a basic entry above the doji and a stop loss below the doji. That's about the tightest we're going to go on a daily candle. Now, what we're looking at is, does it qualify risk versus reward? This is the amount of your risk. So the amount of risk here, and what I'll do is I'll make that risk area red so you have something to compare it to. So here is the risk area from your entry to exit. If you get stopped out, and this is the trigger right here, here's your stop loss roughly here. You can see the size of the risk reward. Now, what we're looking at is if you trigger in above the candle, here's your stop loss. That is the size of your risk. And you position size accordingly. You know, of course, we do a minimum of 3 shares, 3 contracts so we can manage correctly. Target 1 is going to be 1 ATR or roughly the next pivot high. So here is target 1. I'm going to show you target 1 right here. This is going to be target number 1. That means we want target number 1 to be at least the size of the risk. So let me put that box in here. And there you go. So that qualifies for reward. And then target number 2, I'll show you in a second. I'm going to zoom out. This is going to be right back here at the next resistance. And let me just bring this up so I can size this correctly. Right there. Target number 2 is way back here. I'm going to put the arrow here so you can see the last resistance. This is going to be target number 2. That's going to be up here. And then that would be the next target. So you want to make sure target 1 is at least the size of the risk. But the total for target 2 is at least 2 to 1. And as you can see here, this qualifies for at least 2 reward to 1 risk down here. Now, how do you manage it? This is all about the management. The management is very simple. I'm going to show you a real simple technique. So what happens is we're going to look for target 1, and then I'm going to label up here T2. Here's target 2. If we're lucky enough to get target 2. So the first goal is to get your stop loss to break even. You want to move your stop loss to break even. So when we get that first candle or that breakout trigger, it might look something like this. And then it goes something like this. As soon as you get to target 1 here, and let me move this so you can see it. As soon as you get to target 1, which is right here, I'm going to put a little line on target 1 anywhere near there. As soon as you can get the stop loss up, and the stop loss is yellow here in this example, you put it at least on your break even. Now you have 0 risk or below one of the candles, but you want to get it at or above your break even. Here's your break even where you triggered. Now we hit target 1, you take off a 30-year profit. So that's where part 1 comes in. The next candle goes up. If you're lucky enough for it to continue up, or as it continues up, I'm going to move this candle to target 2. As you get to target 2, you can take the second part off, or you can just move a stop below, move your stop below. And I want to make this clean so you can see it. Target 2. So I'm going to take my stop loss, which is yellow here in this example, and I'm going to move it all the way up below this candle. So I'm going to take another third off as soon as it pivots back below, or you can take it off and hit target 2. I like to use what's called a manual trailing stop. So that's 2/3 of your position gone. So now where does the third and final one go? Well, you see this moving average, the 10-day moving average? As the stock is going up, you're going to notice the 10-day moving average is going to be following right behind it like this. And that is where I like to keep. And again, you can take profit anytime you want. I like to keep my stop loss under target 3. So I'm following the trend as long as it's bullish, going for target 2 or higher. So again, looking at your layout, it's pretty simple. Target 1 is where you take profit. Target 2 is where you take profit again with a manual stop loss. And target 3 or above, you just leave it under your stop loss under the 10-day moving average. So there you have it. Measure your targets. Make sure they're greater than your risk. Make sure you know what your target 1 and 2 are. And then have your stop loss raised to break even as soon as you can. Then again, trail it after it hits target 1, and then have a longer term target under the moving average, or at least a good ATR or 2 away. There is trade management technique. There's many techniques. That's just one of them. That is called the Wall Street IO trade management off of Doji. We do this every day at Gino Live for an hour a day, every day. Management is everything. It doesn't matter the stock picks. You can pick the same stock as somebody else and enter at the same place, but it's how you manage and where you take profit, which matters. There's a saying, it's not what you make, it's what you keep. It doesn't matter how high the stock price is until you cash in and protect your risk, it's not profit. Another lesson, Wall Street IO.